Imagine you've got exactly $100 to invest today, and you've managed to narrow your choices down to two of the absolute most popular, closely watched stock market indexes in the world. We're talking about the S&P 500 and the Nasdaq 100. Now, both of these powerhouses have delivered some truly impressive long-term returns. Both give you direct exposure to some of the absolute biggest companies on the planet. And, both are just incredibly popular choices for long-term investors who are looking to build serious wealth.
But that brings us to the million-dollar question, or, well, the $100 question for this explainer. Which one is actually better for you and your specific money, right? Should you choose the heavily diversified, broad market approach of the S&P 500? Or should you go all in on the more aggressive, technology-heavy, growth-focused Nasdaq 100? I mean, it's a massive decision for your portfolio.
So, to figure this out, we're going to put both of these financial giants right next to each other in the ring. We'll run a head-to-head matchup, comparing them on diversification, risk, growth potential, dividends, and their major holdings. By the end of this explainer, you're going to have a crystal clear idea of exactly which index actually fits your personal investment strategy.
Okay, let's kick things off with the S&P 500. This index tracks roughly 500 large, publicly traded companies in the United States. And the absolute key word to remember here is sectors. These companies cover a ton of different sectors across the entire economy. When you invest in this index, you're getting a piece of technology, healthcare, financial services, consumer goods, industrials, energy, communication services, the whole shebang. It's essentially a massive, broad slice of corporate America.
And looking at who is actually inside this index brilliantly illustrates its true power. Think about the heavy hitters represented here. You've got Apple, Microsoft, Amazon, and Nvidia, sitting right alongside Berkshire Hathaway, JP Chase, and Johnson & Johnson. The biggest advantage of the S&P 500, it's diversification, period. Instead of trying to pick one single winning company and risking your hard-earned money on that one choice, you're spreading it across hundreds of major American businesses. If one company completely drops the ball, it doesn't just destroy your entire investment. And that is exactly why the S&P 500 is so often considered the ultimate strong foundation for a long-term portfolio. It gives you that broad exposure without the headache of picking individual stocks.
All right, let's step over to the other side of the ring and look at the Nasdaq 100. This index tracks 100 of the largest non-financial companies listed specifically on the Nasdaq exchange. And man, this is where things get really interesting. See, the Nasdaq 100 has a vastly stronger concentration in technology and growth-oriented companies compared to the much broader S&P 500.
Just think about the massive drivers inside this index for a second. Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Broadcom, Tesla. These are the businesses playing a major role in the staggering growth of the modern digital economy. We are talking about the industries of tomorrow, happening today. Artificial intelligence, cloud computing, semiconductors, social media, electric vehicles. These are exactly the types of cutting-edge industries driving the Nasdaq 100's incredible growth. But there's always a trade-off, right? Because it focuses so heavily on tech, it is way less diversified across other sectors of the economy.
Section 1. The showdown, risk versus reward.
Okay, let's dive right into this. When we compare them side by side, a very clear trade-off emerges. The S&P 500 gives you broad diversification, which generally leads to lower volatility. The Nasdaq 100 totally sacrifices that broad diversification for a heavy concentration in tech. That means higher volatility, but potentially much higher growth. It's that classic safety in numbers versus swinging for the fences dynamic. If tech stocks are booming, the Nasdaq 100 is going to benefit tremendously. But if tech and growth stocks hit a major sell-off, it can fall sharply.
Let's talk a bit more about that growth. Historically, the Nasdaq 100 has often produced stronger returns than the broader S&P 500 over certain long stretches. Companies building AI infrastructure, chips, and cloud networks could see years of surging demand. But here is the catch you cannot ignore. Higher growth potential usually comes with higher risk. The Nasdaq 100 is absolutely not guaranteed to outperform the S&P 500 in the future. Markets change, interest rates change, valuations change. The industries that dominate the world today might not be the kings 20 years from now. You simply can't just look at historical returns and assume the exact same thing is going to happen again.
And this brings us to a huge mistake a lot of newer investors make. They look at the Nasdaq 100's impressive track record and think, well, why wouldn't I just put all my money right there? The answer? Volatility. Because of its intense concentration in growth companies, the Nasdaq 100 can experience some pretty wild price swings. When interest rates go up, investors usually aren't as willing to pay top dollar for future growth, and that puts immense pressure on tech stocks. During a major market correction, the Nasdaq 100 can drop fast and hard. Now look, the S&P 500 can definitely fall heavily during a crash too. It's still the stock market. But having that broader diversification acts like a shock absorber, significantly reducing some of that concentration risk.
So, what about dividends? This is another area where the S&P 500 generally takes the win. It includes a lot of mature, established companies that regularly return cash straight to their shareholders through dividends. The Nasdaq 100, on the other hand, is completely packed with growth companies, and growth companies usually prefer to take their profits and reinvest them right back into expansion, research, and developing new tech, rather than handing out cash to you. So, if steady income is your goal, the S&P 500 might be your best bet. But if you're all about capital growth, the Nasdaq 100 makes a very compelling case.
Now, what's really interesting about all of this is a fun little plot twist. After all this head-to-head comparison, you don't actually have to choose only one. A lot of investors strategically use both of them. You could totally make the S&P 500 the stable bedrock foundation of your portfolio and then sprinkle in the Nasdaq 100 to deliberately boost your exposure to technology and growth.
But wait, before you rush out and buy both, we need to talk about index overlap. The crucial point here is that owning both doesn't automatically make you a master of diversification. It actually might just mean you really love Apple and Microsoft. There is massive overlap between these two indexes. Many of the absolute largest tech companies in the Nasdaq 100 are also the largest companies in the S&P 500. So if you hold both, you are effectively doubling down on those specific mega-cap companies. And hey, that's not necessarily a bad thing, but you absolutely need to know what you're actually holding so a sudden market shift doesn't catch you completely off guard.
Section 2. Your winning strategy.
So, let's bring this all together and build a super simple cheat sheet based on your unique goals. Here's the breakdown. Number 1. If you're a beginner wanting a simple, broadly diversified investment, or if stability is your main priority, the S&P 500 is an incredible starting point. Number 2, if you are an aggressive investor, you specifically want that heavy tech and growth exposure, and most importantly, you have the stomach for wilder price swings, the Nasdaq 100 is super attractive. And number 3, if you want broad diversification, but you want to tilt the scales a bit toward growth, you can own both, just as long as you're totally aware of that overlap risk we talked about.
Look, whichever path you end up taking, just remember this fundamental truth. Building real wealth isn't about finding some magical index that's going to make you rich overnight. The actual secret, it's finding an investment strategy you can stick with for years or even decades, especially when the market crashes and everyone else is panicking. Successful investing is about time in the market, it's about consistency, having the discipline to not panic sell, and really managing your own personal risk tolerance.
So the S&P 500 for broader diversification, the Nasdaq 100 for greater growth potential, or maybe a strategic mix of both. Remember, past performance never guarantees future results, and of course, this explainer is just for educational purposes, not financial advice. But I really want to hear from you. Now that we've popped the hood and looked at both of these massive financial engines, tell me in the comments, are you choosing the S&P 500, the Nasdaq 100, or both? Think about your long-term goals, make your plan, and I will see you in the next explainer.